right, so in this problem, um, we are asked to assume that fixed costs are $434,750. So our question is, how many units of the standard? So notice in the problem, we have two different products here. We have a standard, we have a heavy duty. We're specifically looking at the standard here. So how many standard units would be included in the total number of units required to break even with the projected sales mix? Now, this one we have to be careful with the sales mix because it's so simple that it could confuse us. So first of all, this is the sales mix. My highlighter is humongous there, but you can tell that that is the sales mix. Um, so what we notice here is it's 50-50, right? 50% basically. So I've actually done all the calculations here, but I want to walk us through them. I wanted them to be on the screen so you could write them down if you needed them. So the first thing we have to do is find the weighted average or the weighted average contribution margin for our product. So to do that, we start by finding the contribution margin for each type of product. So luckily in the problem, they gave us the selling price per unit and the variable cost per unit for each product. So I start with the selling price per unit of the standard, which is 300 and 150 for the heavy duty. The variable cost per unit is 153 for the standard and 62 for the heavy duty. So sales minus variable cost is contribution margin. So that's what we're looking for here is contribution margin. So we find that the contribution margin of the standard is $147 per unit, and the contribution margin for the heavy duty is $88 per unit. So now that we've found the contribution margin for each type of product, we can find the weighted average contribution margin. So to get our weighted average contribution margin per unit, we're going to take the number of units produced and sold of each one, which is 5,000 for both. We're going to add those together. That gives us a total of 10,000. So to get the proportion of each one, we would take the amount of each one and divide that by the total. So 5,000 divided by 10,000. Okay, that's 50% or 0.5. Then we would take that and multiply that by each one. And that would give us our weighted average contribution margin for each one, 73.5 and 44. If we add those together, we should get 117.50, which is actually what I have down here. Because if the proportions are the same, we can simply take the contribution margin of each one, add them together, and divide by 2 to get an average of the two numbers because the proportions are the same. And so you will still end up with $117.50. Now, of course, that doesn't answer the question. That's just the weighted average contribution margin. So to answer the question being asked, we need to first find the break-even point. So remember the formula for break-even point. It's fixed cost divided by contribution margin. In this case, it's the weighted average contribution margin. So our fixed costs were $434.50. So we're going to take that number and divide it by our weighted average contribution margin that we just found, 117.50, and that gives us those 3,700 units in total to break even. Again, that does not answer the question, but notice it's one of the solutions. But that doesn't get us to the answer. That's the total number of units to break even. We don't want that. We want just the standard that we need to break even. So now we go back to our proportions, which is 50%, and we're going to multiply the 3,700 times 50% or divide by 2, which is the same thing, and that gives us 1,850 units to break even for the standard number of units. In this particular problem, we have the accounting records of Grant Manufacturing Company, and we have our direct materials, our direct labor, our fixed overhead, and our variable overhead for the production of 10,000 units. And of those 10,000, we only sold 7,800 of them, and we sold them for $138,840 in revenues. So the question is, under variable costing, what is the contribution margin for the year? So again, we have to remember our contribution margin income statement, which is sales minus variable cost, is contribution margin. So those are the numbers we're looking for. So we were given sales, so we can go ahead and put that down there, 138,840. But now we need to find variable cost. So remember, we only expense under variable costing, we only expense the product cost when product is sold. So we have to figure out our per unit cost for producing these 10,000 units, but we don't expense the cost associated with all 10,000 because we only sold 7,800. Okay, so we'll take these costs, we'll add them all up here, but notice it's only the variable cost that we're adding up. We don't use the fixed cost because we don't have fixed cost to find contribution margin. Okay, so we're only going to use direct materials, direct labor, and variable overhead. Okay, so only the variable cost. The fixed cost would appear below contribution margin down here, okay, to find operating income. All right. So we have direct materials of 21,000, we have direct labor of 58,000, and we have variable overhead of 28,000. That gives us a total variable cost of $107,000 to produce those 10,000 units. Okay, not the answer. We've got to divide that by 10,000 units, and that tells us it cost us $10.70 per unit to make, right? But again, we only sold 7,800. So we're only going to expense the cost associated with 7,800 units. So if you multiply the $10.70 per unit times the 7,800 units sold, that gives us $83,460 in variable cost. When you subtract that from your sales revenue of $138,840, we get a contribution margin of $55,380. And unusual, it is none of these answers are correct.